Thursday, but here we are at the start of the week, and I'm just getting into it now. Good news is I know you guys don't have class tomorrow because of the job fair. So we're going to pivot a little bit here, and I'm going to start integrating PowerPoint slides more into the class starting today. I'm going to still use the homework format I've been using, as well as some additional problems for now. But let's just start by going over these slides. I think it's important to set a foundation beyond just, number crunching, time value of money calculations. I think it will help give you guys some understanding and context for the course. And as always, let me know if you have any questions. So chapter 1, financial environment. What are some of the chapter outcomes? So define finance, describe the 6 principles of finance, identify characteristics of an effective financial system, describe financial functions performed in any effective financial system. Describe the 4 types of financial markets, characteristics of mortgages, discuss the developments that led to the recent financial crisis, which one, this one or the one before, identify several major career opportunities in finance. So first, let's start with the basics. What is finance, right? Finance is the study of how individuals, institutions, and governments and businesses acquire, spend, and manage money and other financial assets. And the environment encompasses the system, institution, markets, and individuals, effectively what we refer to as market participants, and how they make the economy operate efficiently. Next, the 3 areas of finance within the financial system. So institutions and markets, investments, and also financial management. Note these areas do not operate in isolation, but they are integrated and intersect with one another. So definitions, financial institutions, that's they help financial system operate efficiently and transfer funds from savers to investors. So you think about, you've heard things recently in the news about GameStop related to these clearinghouses and hedge funds that can act as clearinghouses like Citadel. And then you have the markets, which are the physical locations or electronic forums that facilitate the flow of funds. For this example, financial market, think New York Stock Exchange, NASDAQ. For most of us, buying and selling, it doesn't even matter what financial market is on. As long as your broker can trade it, it's just another security. Investments, that involves the sale or marketing of securities, analysis of securities, and the management of investment risk. Financial management involves financial planning, asset management, and fundraising decisions to enhance firm value. Entrepreneurial finance, study of how growth-driven, performance-focused, and early-stage firms raise funds and manage operations and assets. So how do you scale up an organization, right? You can use finance not just for buying stocks. You can use finance to how to effectively lever up in an organization to grow fast. Things like deciding to purchase something and make it yourself versus someone else make it for you, right? And what are the different cost structures in those? Well, if you make something yourself, there's a huge upfront cost. If you have someone make it for you, it's a low upfront cost, but a potential high ongoing cost. Personal finance, that's the study of how individuals prepare for financial emergencies, protect against premature death, loss of property, and accumulate wealth. Why study finance? To make informed economic decisions, to make informed personal and business investment decisions, to make informed career decisions based on a basic understanding of finance. One thing, just a basic financial math, you guys get your first job, you get $50,000 a year, you get a 20% raise, you're at $60,000, right? Sounds like a great percentage, but an extra 10 grand is nothing for most of these companies. Meanwhile, someone getting 200 grand gets a 20% raise. They've already eclipsed, their raise has eclipsed your salary, right? Because they're getting now another $40,000 of income. 6 principles of finance. Money has a time value. We've beat this topic to death so far. Higher returns are expected for taking on more risk. The discount rate we've used in some of these math problems represents that risk. Diversification of investments can reduce risk. So being invested in different areas. So, for example, having exposures to tech versus healthcare. 6 principles of finance. I will take a step back there and I compare tech versus healthcare. Tech versus healthcare, can trade different and can be diversified. But if you're in a risky biotech and a risky tech company, you probably won't have that much benefit of diversification. Today is February 22nd. Growth stocks, doesn't matter which growth stock you own, they all had a sell-off, right? So if you had Virgin Galactic or CRISPR Therapeutics or any high-flying biotech, they likely didn't do well today because they trade the same. So continuing on, financial markets are efficient in pricing securities. They are mostly efficient, right? Manager and stockholder objectives may differ. That's called the principal agent problem. Let me give you an example of principal agent problem. I'm running a bar. I'm the bar manager. My friends come in for drinks. Do I give them the drinks for free? Yeah, I'm just the manager, right? It actually doesn't cost me anything to give my friends free drinks, right? It costs the owner money, not me. So, and who's going to tell on me? Nobody. So there's a principal agent problem, right? The manager might have a slightly different incentive than the owner, right? And then reputation matters. So, just like being in any deal, right? You don't want to get involved in a deal with someone who's untrustworthy. Time value of money. We already talked about this a great deal, but money in hand today is worth more than the promise of future money. Time value of money exists because the sum of money today could be invested and could grow. Risk return trade-off. So, the trade-off when you invest in something very risky is that basically the spectrum of returns has increased greatly, right? Let's think about a high risk stock. Pinterest, right? It's not the most risky, but Pinterest is what I would consider a higher risk stock, right? The returns could vary widely, and the stock could double or get chopped in half 40%. And, that probably wouldn't shock any of us. Now, take another stock, General Mills. They make cereal and dog food. We would have a smaller band of expected returns because we would expect cereal consumption to probably grow with population growth, and we wouldn't expect too much variability in that population growth. So that would just be one example there. Diversification of investments. I touched on this a minute ago. All investment risk is not the same. Some risk can be removed or diversified by investing in securities or in several different assets. One topic I'd mention here is that, I had a client and he was invested primarily in companies that earn no profits. So they traded very similarly, right? They traded like growth stocks. So he appeared to be diversified, but the problem is that he was very exposed to the growth factor, and growth stocks will move with interest rates. When interest rates start going up, growth stocks will get, cranked. And when interest rates are low or going down, growth stocks will outperform. Now, this little bout of interest rate increases in the long run, and I won't go into too many details because it is a complicated topic, could reverse, right? So I think it's just a multi-day event. Efficient financial markets. Financial market is information efficient if at any point in the time prices of securities reflect all the publicly available information. When new information becomes available, prices quickly change. That's mostly true. Information efficient markets provide liquidity and fair prices. So, one thing that's different about trading a home versus trading a stock is stocks are very liquid. You can get in and out of a stock in most cases in seconds, if not, parts of a second. Well, the housing market is liquid for housing, but it could take you 30 to 60 days in a best case scenario to get paid. We're in stocks, same day, within days. Manager versus ownership objectives. Management objectives may differ from the owner. Again, principal agent problem. I already reviewed this, so I'll skip over this pretty quickly. Owners and equity investors want to maximize the return, but managers may seek to have other goals. I used an example of theft, but sometimes a manager, what does a manager want? They want to be more powerful. They want to have more people they manage. They want to be a bigger manager, managing more people. So they might, make themselves more valuable before they make you more valuable. It's in their best interest if you set up their incentives that way. So you want to do your best, if you can, to tie manager compensation to performance measurements that are beneficial to the owners. The problem is if you have cheap owners, they don't like giving extra compensation for good work, and that might be against their own economic interest as well. Our reputation matters, so ethical behavior, is very important. How an individual or organization treats others legally, fairly, and honestly. High reputation reflects high quality ethical behavior. So employing the right ethical standards is the right thing to do. Overview the financial system. So you have policymakers, the Fed, politicians, government. They set the regulations and rules within the system. At one point, you could get a home with no money down. Maybe 15 years ago. Now you can no longer do that, right? Why? They changed the policy. Monetary system. Right now, the monetary system is very loose. Why is that? Many people are getting free money, or what we would call free money. Loans are easier to get. The federal government is finding ways to get money in people's pockets. That's will drive down interest rates, depending on how long it goes on for. Institutions, though, can be depository institutions, savings, securities firms, and the financial markets. I talked about that: NASDAQ, New York Stock Exchange. There's mortgage markets, derivative markets, etc. Financial system components and financial functions. Monetary system creates the money, transfers the money. Financial institutions, they accumulate savings and lend. Financial markets, marketing financial assets and transferring financial assets. They might be pitching assets. They might be trying to get investor interest. Money markets, really easy to remember. Money market funds are basically like cash. On a line item in a portfolio, they're actually treated as cash. They're very high quality, short term, liquid debt vehicles. So if you have a debt that's due tomorrow, that's as good as cash, especially if it's from a high quality organization. If Walmart has to pay you back a debt in 2 days, you're going to treat it like cash because they're high enough quality. They're good for it. Capital markets, that's where debt securities with maturities longer than 1 year and corporate equity securities are issued. Difference between primary and secondary markets is the primary market is where the stock has its initial public offering, and the secondary market is where you and I trade those shares. Debt securities, again, those are bonds, pieces of debt. You're going to earn interest on those securities. There's also equity security markets, obviously, where ownership rights are the form of stocks, sold, bought, traded. Derivatives, foreign currency, mortgage markets. One of the issues in the financial crisis was that they were packaging all these bad mortgages, and when they packaged them together, the banks were like, "Oh, it's diversified, so it's actually high quality." And one of the funnier people I used to work with in 2007, pardon my language here, he said the mortgage market, and when they resold, the banks bought mortgages and then resold them to the public. It was like they took chicken shit and mixed it up and called it chicken salad, right? But that was not the case. So, that was what happened in that market. So the banks were basically saying the mortgages were less risky than they were. Fixed rate mortgage, pretty common. You go to buy a home, you're likely to go for a 30-year fixed rate mortgage. That's a pretty vanilla mortgage. Adjustable rate mortgage, that was actually my first mortgage. Why? Because it has a low introductory teaser rate for a 5-year period, typically, followed by rates that adjust with the market. But a 5-year teaser rate, 5 years is a long time. If you're buying your first condo and it's a bachelor pad or a bachelorette pad, you might not plan on having it for more than 5 years. So one of these lower teaser rates for a 5-year period is fine. What happened in my case is that I bought in 2005. By 2010, the market still hadn't kind of recovered. So the interest rate on my mortgage kept on adjusting down because the Fed was lowering rates. So my payment got lower, and it made it more affordable. But if rates went up, my property value would have went up, my payment would have went up. Securitization, that's just what I talked about. When the banks aggregate these mortgage bonds together and effectively you'll buy it in the form of a mutual fund, and it'll pay you like 3 or 4% interest. That's why you buy a mortgage fund in order to collect those coupons. And besides the financial crisis, mortgage bonds have been a pretty good investment. Why? Because they're backed by a high quality asset, typically. Credit rating, touch base on what I just talked about. Credit rating indicates the expected likelihood of the borrower. It's kind of like your credit rating and the credit score, very similar. Companies and individuals can all have some form of a credit rating. The prime mortgage, that's a home loan made to a borrower with a relatively high credit score. Subprime is a low quality mortgage. So you have mediocre credit and you have a higher interest rate. Talking about the financial crisis, we've talked about this a great deal, and we'll continue to talk about it throughout the semester. So I'll skip over this. And I'll leave some of this to the in-person component. Careers in finance are so broad. You could be in financial management. You could have a marketing role. You could be involved in securities, sales securities. You could be in operations. It's just so broad. You could work, for Bose, the headphone company, and work in the finance department there. Cash management analyst, capital expenditure analyst. Analyst is a very common term for entry-level-ish positions. Bank teller potentially, right? I've seen some people go into retail banking side to get loan officer jobs, things of that nature. Other ones, insurance broker, not for me. It's way too salesy. Research analyst, that's something that I find attractive. Real estate agent, always want to get my real estate license, never have. It'd probably be financially beneficial for me to do so. Stockbroker, that's kind of dying, right? Financial planning is more of, financial planner assistant is probably replace the stockbroker. We'll just skip through this here. I think that's good. Now we're just going to roll right into chapter 2. We'll make really good use of our time today for this recording. Here we go. Money in the financial system. So this chapter will talk about 3 ways in which money is transferred from savers to businesses, identify the major components of the monetary system, describe the functions of money, and give a brief review of the development of money in the U.S. Describe major types of money market securities. We already talked about that. That's why it was pretty easy. Money market securities are like cash. There's different levels of money. Like money in your savings account is different than money in your checking account normally. And that's kind of touches on M1, M2, and M3. Explain the possible relationship between money supply and economic activity, and then comment on developments in international monetary systems. Process of moving money savings into the investments. So you have a surplus, generates more money than it spends, resulting in excess money, and then deficit generates less money than it spends and in need for additional money, right? So are you a saver? Are you a spender? Is really what this does. So investment banks and financial institutions basically help move capital, right? They help the money from savers get in the hands of investment firm or companies that need capital. Central bank, that defines and regulates the money supply. You hear about the Fed, that's the central bank. They facilitate the transferring of money. They create money, transfer money. They provide intermediation. They're the ones who make sure it gets from point A to point B, processing and clearing checks. Won't spend much time on this, but the central bank loans money to our banks that we go to. And that's how the Fed kind of gets into the system on that side, to the banking system. So if your bank needs money, they get a loan from the Fed. Federal Reserve System has a board of governors and Federal Reserve banks that have slightly different functions throughout the country, and they effectively act as a committee. And they vote on things like raising and lowering rates, which is why appointments to the Federal Reserve are so important and usually taken so seriously. They define and regulate the money supply. They facilitate the transfer of money, again, through the check clearing process. Functions of money, real assets. You can own something, land, home, equipment, durable goods, precious metals, and then financial assets, money, debt securities, equity contracts backed by real assets, and then earning power. Some basic functions, money, anything generally accepted as payment for goods and services, not Bitcoin, because who accepts Bitcoin for payment for anything, right? Barter, right? Exchange of goods and services without using money. And then liquidity, ease and cost of exchanging an asset for money. For example, you guys might not be aware of this, but bonds have terrible liquidity compared to stocks because there's so many different, Disney might have 40 different bonds, but they only have like one stock. So the stock's really liquid, their bonds are not relative to the stock anyway. Liquidity can hurt your pricing. Where's an example where liquidity can hurt your pricing? If you don't know like what the last item sold was, or if the last item that was similar to yours was sold a long time ago, like what is it worth now? Who knows? It's almost like selling a collectible, right? Money is a medium of exchange, store of value, and a standard of value. Historical types of U.S. coins. This is not really relevant, so we'll skip this. We can skip that. Credit money, money worth more than what it is made of, backed by the issue, credit worthiness. Then we have deposit money. That's a special type of credit money backed by depository institution. And again, good for definitional purposes, but I won't revisit this too much. Automatic transfer service accounts, debit cards. We don't need these definitions. We know about transferring of money and what a debit card is. Money markets, as I mentioned, they act as a proxy for cash. If you're an investment firm, or even if your parents have a fidelity statement, likely the cash is actually not in cash. It's in a money market fund. Treasury bill, that is usually a component of a money market fund. There's also a negotiable certificate of deposit. So treasury bills are government securities, and then the certificates of deposit can be from banks. Then there's also commercial paper. Commercial paper would be like that short-term Walmart loan I mentioned to you. And then bankers' acceptance notes. Again, high-quality loan that pays low interest. Repo agreements, which I won't get into right now because they're a little bit complex. Short-term debt security where the seller agrees to repurchase the security at a specific price and date. And then the federal funds rate, which is issued by the Fed. And as we're here on talking about money supply, the M1, M2, and M3. So M1 includes currency, traveler's checks, demand deposits at banks, other checkable deposits, the easiest form of money to access. M1 money supply plus, so savings accounts, small denomination time deposits, money market funds, right? So apologies, this is M2, right? Savings accounts, small denomination time deposits, money market deposits, right? Whether it's a fund or you own the actual securities. So why? Because, to get the money markets, even though it's like cash, there's still a little bit more time to get out of that security. Their liquidity is a little bit different. Even with your savings account, it might take a little bit longer for that money to move compared to a check. And that's why it's M2. M3 includes large denomination time deposits, right? You have like a few $1 million in Bitcoin. If we counted that as money, it's not going to be easy to move that around rapidly, at least converted to cash. Large money market funds, repurchase agreements, and then euro dollars. So these kind of more funky FX related vehicles. Money supply and economic activity. We've talked a great deal about this already. But the monetarist view is the amount of money in circulation determines the level of activity. The truth is these are two academic viewpoints. Neither one are probably 100% accurate. But if we want to stimulate the economy, we increase the money supply. If we stimulate the economy too much, we get inflation and no economic benefit. We're not there yet. That's like a concern conservatives have at the moment. I mean, conservatives as from the economic perspective. But for the last 25 years, we've heard economic conservatives, worry about inflation, and it has not appeared in a meaningful way. Keynesian view is changing the money supply first causes a change in interest rates, which then in turn alters the demand for goods and services. I probably lean more on the Keynesian view. Monetarist theory, the basic equation, money supply and velocity of money equals GDP. Gross domestic product, term you should be familiar with, measures the output of goods and services in the economy. And then let's go back to that equation. Money supply minus the volume of money or velocity of money equals GDP. Well, it's like we have a fixed supply of money, and velocity is the speed at which it's spent. So if the money is being spent really fast, it's just like the economic machine is just chugging along pretty fast. So, you can decrease the money supply, but if the velocity of money speeds up, that's better. One thing that has improved our GDP, when I think about the velocity of money, think about the time it takes for you to earn money today versus your parents 20 years ago. You couldn't just turn on Uber and drive and make cash. You would have to like apply, wait weeks, talk to people, wait for people to get back to you. That increases the velocity of money. Another way to get to GDP could be using the output of all goods and services multiplied by their price level. They should both get you the GDP, right? As we see right here. That also means that money supply multiplied by velocity equals real output multiplied by price level. So an increase in money supply or velocity will increase GDP, as will an increase in output or price level. The money system used to be tied to the gold standard. That gave the central banks very little flexibility, because if you're tied to the gold system, you can't move your currency. But now, our currency can fluctuate. So when we want to have a weaker currency to stimulate the economy, we can. When the economy is running too hot, we increase interest rates. Currencies also have to do with interest rates. If we're lowering our rates while China is increasing their rates, their currency will become more valuable and ours will go down in value. When our currency goes down in value, our exports will appear more attractive because our currency is now cheaper, while China's exports will appear less attractive because their currency is more expensive. It effectively puts your currency's goods on sale or at a premium. That's all I had for these two chapters, guys. So I'll post that now, and I'll see you guys on Thursday. Good luck at the career fair. And as always, feel free to just reach out if you have any questions.